Hi! What if I told you one of the most simplest tax planning strategies is right in front of your eyes? Like staying part of your family. Sounds too good to be true. Welcome to the world of HUF. Now, before you rush to open one, let's try to break it down a little bit. In this video, we'll cover what is HUF, what is the basic structure of it, and more importantly, how does it help us save taxes. In the next video, we'll cover what are the most common mistakes and how to avoid them. So, before further ado, let's get started. So, what is HUF? HUF basically stands for Hindu Undivided Family. Now, even though it has the word Hindu in it, can be formed by anyone who is governed under the Hindu law, like Jains and Buddhists. The fun fact about HUF is that it is treated as a separate tax entity, which means almost like a separate individual. Now what this means is that like how individuals in a family can earn money, own property and have to pay taxes separately, the HUF is eligible to do all the same. So it has a separate PAN card and a bank account. Now let's dive a little deeper and try to see what is the structure of HUF. So like how a company has CEO, shareholders and employees, the structure of HUF can also be categorized into three parts. The first one is Karta, who is the eldest member of the family, and like a CEO, he or she is in charge of the day-to-day operations and managing the wealth. Second are co-partners. These are basically the direct descendants like son, daughter or grandkids. And like how shareholders have a right to the company, the co-partners also have a right to assets or the wealth managed by the HUF. Third one are the members. The members are mainly the spouses of the co-partners or other relatives. And one important distinction to notice here is that members do not have direct right to the wealth of the HUF and cannot initiate the partition of it. Now let's take an example to understand it a little better. Let's take Rahul, because naam to suna hoga. Rahul is married and has 2 kids, and family has inherited property. So in the HUF, Rahul being the eldest becomes the Karta, his wife becomes a member of the HUF, and his kids are the co-partners. Now since all of us have families, are they all recognized as HUF under the law? The answer is yes and no. So under the Hindu law, a family is a HUF which has direct descendants from an ancestors and includes their wives. But to be recognized as a separate taxpayer, HUF has to be recognized under the income tax laws. Now under the income tax laws, there are 2 conditions which have to be fulfilled. The first one is co-partnership. That means that Rahul and his wife by itself, they're not recognized as HUF. But when they have kids, kids can be a co-partner in the HUF, and therefore this unit of Rahul, his wife and kids can be recognized as a HUF. Second condition is that there should be joint family wealth. So this can be in the form of assets, land or business income. And since there is co-partnership, HUF cannot be formed by any contract. Now let's get into the interesting part. How does HUF help us plan taxes better? The first one is that since HUF is a separate tax entity, that means the income can be split. The second one is that if we're following the old tax regime, HUF is also eligible for making investments and claiming deductions like ELSs, insurance, house property loans, etc. And another advantage would be wealth creation and succession planning. Transferring assets like gold, land, property through HUF means that it is distributed among various members, and that means less individual tax liability over time. Now let's try to understand how HUF can help us plan taxes better with an example. For example, Rahul is a salaried employee and earns around 30 lakhs per annum. Now his parents gift him 10 lakhs. Now he decides to invest this money in the market and earns say 1.5 lakhs in interest. Now in this case, the tax liability of Rahul is that since he earns 30 lakhs in a year, he is in one of the highest tax brackets. That means that the interest which is earned by him, the 1.5 lakhs, will be taxed at 30% tax rate, which is around 45,000. Now, in another scenario where Rahul, his wife and kids have a HUF, and Rahul's parents decide to gift 10 lakh rupees to the HUF instead of directly giving it to Rahul. Now, the HUF invests this money in the market and earns 1.5 lakhs rupees of interest. So the tax liability in this case is that Rahul does not pay any tax on this interest earned, and only the HUF has to pay tax on this. Now, since HUF also gets the basic exemption like an individual, this 1.5 lakhs of interest is not taxable in the hands, it goes tax free. And therefore, with just this effective tax planning strategy, Rahul saves around 45,000 rupees of tax in the first year, and over 10 years he'll save around 4.5 lakhs. And all this just by structuring the family wealth properly. Limitations. Now, is that to say that HUF is the most effective tax planning strategy ever? No, there are definitely some limitations. The first one is compliance. Now, since a HUF is going to be treated as a separate tax entity, that means there should be a proper deed in place, there should be a separate PAN card, bank details, proper records, and all that have to be maintained for it. The second one is dissolution, which means that partition of the HUF. So, since HUF is made up of the family members, any disputes or conflict can result in the partition, and basically it means that all the members, co-partners and karta have responsibility to make sure that it's functioning smoothly. Another one is loss of individual deductions. So that's it. This is the basics of how a HUF is structured and how it works. But did you know that if you transfer your personal assets to HUF incorrectly, you still end up paying taxes on it? That's right, there's something called the clubbing provisions and the ownership rules which apply. But hold on, it's not as complicated as it seems. So in the next video, we'll dive into that and take a look at the most common mistakes done in a HUF and how best to avoid them. So see you there. Bye bye.